Something is about to happen in the silver market that most investors won't understand until it's already over. Not because the data is hidden, not because you need a Bloomberg terminal or a seat at a Goldman Sachs desk, but because the financial media is focused on the wrong things, chasing headlines, reacting to yesterday's news, while something far more structural, far more irreversible, is quietly assembling beneath the surface. In the next 11 days, 5 specific events are going to collide. And when they do, silver, which has already broken out of a multi-decade consolidation, may be staring at $59 an ounce, not as a fantasy, not as a permeable prediction, as a mechanical outcome of supply, demand, monetary policy, and industrial reality converging at the same moment in time. The question isn't whether you believe in silver. The question is whether you understand what's happening and whether you're positioned before the rest of the market wakes up. Let's go through it. Event 1 happened quietly, almost without fanfare. The Federal Reserve, after months of language that tried to sound hawkish while acting reluctantly, signaled what institutional desks already knew was inevitable. The rate cut cycle is not finished. The pause was never a pivot away from easing. It was a pause before the next leg down. And every time in modern financial history that real interest rates have turned negative or moved towards zero, silver has responded with violence to the upside. In 2010 and 2011, when the Fed held rates near the floor while inflation expectations rose, silver went from $18 to $49 in roughly 14 months. That's not an opinion, that's the tape. And right now, the real yield environment is shifting again, quietly, beneath the noise. But here's what most people don't understand about silver, and this is the part that separates the informed from the emotional. Silver is not just a monetary metal. It's not just a hedge against the dollar. It is an industrial input that the green energy economy, the AI infrastructure build-out, and the defense sector cannot function without. Solar panels require silver. Every single one. The photovoltaic cells that convert sunlight into electricity use silver paste as a conductor, and there is currently no viable substitute at scale. Global solar installations hit record levels last year. They are projected to grow by another 30% this year, and they are not slowing down. Meanwhile, AI data centers, the ones being built right now at a pace that's difficult to comprehend, require silver in their electrical contacts, their switches, their high-frequency circuit boards. The Silver Institute estimated that AI-adjacent industrial demand could add tens of millions of ounces of additional annual consumption by 2026. We are at 2026. That demand is not theoretical, it's arriving. So you have a metal that is simultaneously a monetary asset being repriced by a weakening dollar and an industrial commodity being consumed faster than miners can pull it out of the ground. That combination doesn't happen often. But when it does, the price moves are not incremental, they are structural. Event 2. COMEX registered inventory, the silver actually available for physical delivery, has been sitting near multi-year lows. This matters more than almost any other data point in the silver market, and almost no retail investor tracks it. Registered inventory is not the same as eligible inventory. Eligible silver sits in vaults, but hasn't been designated for delivery. Registered silver is the metal that's actually on the hook, the silver that could be called upon when futures contracts demand settlement. When registered inventory drops while open interest in futures remains elevated, you get a structural vulnerability. There isn't enough physical silver available to satisfy the paper claims against it. And that gap between what's promised and what exists has been widening, quietly, consistently, for months. If even a fraction of futures holders demanded physical delivery simultaneously, the COMEX system would face a stress it has not faced in decades. The price response to that kind of squeeze would not be measured in percentage points, it would be measured in multiples. Event 3 is geopolitical. And this is where the story gets uncomfortable. The world's largest silver-producing nations, Mexico, Peru, Chile, China, are not politically stable in the ways that Western supply chains require. Mexico has been nationalizing energy infrastructure and increasing state control over mining concessions. Peru has experienced repeated social unrest that has disrupted mine output. And China, which produces and consumes silver on a scale few people fully appreciate, has been tightening its grip on critical mineral exports as part of a broader geopolitical posture that is not going to reverse. Meanwhile, the United States has made it a strategic priority to reshore critical mineral supply chains, That sounds like good news. But reshoring takes years. New mines take a decade to permit and build. The supply constraint is not a 2030 problem. It's a right now problem. And right now, the 5 events are converging. In it 4 is the dollar. The US dollar index has been under sustained pressure, reflecting a slow but unmistakable erosion of confidence in dollar-denominated assets among foreign central banks. Countries that once held US treasuries as their primary reserve are quietly diversifying. Gold purchases by central banks hit record highs in 2023 and remained elevated in 2024. Silver historically follows gold's monetary repricing, but with more volatility, more leverage, and more explosive upside. The gold-to-silver ratio currently sits in territory that has historically preceded silver outperformance. When gold moves, silver eventually catches up, and then overshoots. Every major silver rally in modern history has been preceded by exactly this setup. Gold moving first, silver lagging, and then silver surging as retail and institutional money floods in simultaneously. We are in that lag phase right now. Event 5 is the one nobody is talking about. A major financial institution, not a fringe newsletter, not a social media account, recently published internal research suggesting that silver's fair value, based on its current industrial consumption trajectory, monetary environment, and supply deficit, is somewhere between $50 and $65 per ounce over the next 12 to 18 months. That research hasn't gone mainstream. Most retail investors haven't seen it, but institutional desks have, and institutional desks don't publish price targets for metals they aren't already positioning around. The smart money doesn't announce its moves, it positions first, then the narrative catches up. Now, and this matters, let's be honest about the risk. Silver is volatile, genuinely uncomfortably volatile. It can drop 15% in a week on dollar strength, a hawkish Fed comment, or a broader risk-off move in markets. The $59 scenario is not guaranteed. Nothing in markets is guaranteed. If the global economy slows faster than expected, industrial demand could soften. If the Fed pivots back toward tightening, unlikely but not impossible, real yields could rise and pressure precious metals. If COMEX registered inventory recovers, the squeeze risk diminishes. These are real counter-arguments, and anyone who doesn't acknowledge them is selling you something, not informing you. But here's the asymmetry. In an environment where fiscal deficits are structurally embedded, where the dollar is gradually losing reserve dominance, where industrial demand for silver is compounding faster than supply can respond, the risk of being too early is far smaller than the risk of being too late. History doesn't always repeat, but it rhymes with remarkable consistency. In 1979 and 1980, silver went from $6 to $49 in roughly 12 months. In 2010 and 2011, it went from $18 to $49 again. Both moves were preceded by monetary loosening, dollar weakness, geopolitical tension, and supply tightness. All 4 of those conditions exist today simultaneously for the first time since 2011. The market hasn't priced this yet, not because the information doesn't exist, but because markets price information on a delay. The crowd is always late, the crowd is always confident at the top and terrified at the bottom. The investors who built wealth through precious metals didn't do it by buying when silver was on the cover of every magazine. They did it by understanding the mechanics, the real mechanics, before the crowd arrived. 11 days, 5 events. A structural supply deficit, a weakening dollar, a Fed that cannot afford to be truly hawkish, industrial demand that is not slowing, institutional positioning that is quietly, methodically building. $59 is not a ceiling. It may be a milestone on a much longer road. The real question isn't whether silver gets there. The real question is what you do with that information right now, before the market prices it in, before the headlines catch up, before the crowd rushes the door. Because in financial markets, timing is not everything, but it is the difference between a story you tell with regret and one you tell with conviction. What's your position? Leave it in the comments. Are you holding physical, watching from the sidelines, or completely out of precious metals right now? Let's see where this community stands, because the next 11 days may matter more than the next 11 months.